My name is Jake, welcome to the channel, and today's video we're going to do a review my pie video where I review subscriber portfolios. So yeah, I've been doing this for about, every 3 or so weeks now. For those of you that are maybe new to the channel, my name is Jake. Obviously I start every video with my name. My wife and I, we live down here in Austin, Texas. We have a little toddler, 1.5-year-old baby boy. His name is Lucas. We follow the FIRE movement. We're trying to reach financial independence and retire early. My wife and I were both in well-paid jobs, right? I work as a software sales manager. My wife works in marketing, and yeah, we've been in Austin for about 5 years, and our time horizon is about the next 2 years. We're trying to achieve financial independence in the next 2 years and live off of our dividend income, our dividend portfolio. Earlier, before the pandemic, we invested heavily into real estate. We had a total of I want to say three rental properties, and we decided to sell those rental properties. And that's where you see this big spike in my portfolio is we sold our rental properties, and we've been slowly transitioning them into our dividend growth portfolio here in M1 Finance. So that's a little bit about me, but I wanted to share something really quick. I was looking at the portfolio here and I thought that this was so incredible. So, you've heard me talk a lot about these ETFs, SHD, DGRO, etc. here on the channel, but I wanted to take a look at DGRO, for example. Year to date, DGRO is down, and this is not the total return, this is just the price, is down just, under 7% year to date. I look at the stock market and I think, man, isn't the stock market down like 50 or 30, or it feels like 50, but I think it's like 20 or something percent. It's gone up here these last couple of weeks. But I look at SCHD and I look at the year-to-date performance, not including the dividend. With the dividend, it's positive. But just looking at the price, it's down just under 3% for the year. It doesn't feel like that in the market. It feels like there's a lot more red in the market. And this is what blew my mind is when I look at VYM, this is the high dividend ETF from Vanguard. Year to date, it's positive. This is not even the dividend. Year to date, this ETF is positive. What is the S&P 500 right now? The S&P 500 is year to date down 15.5%. I mean, absolutely insane. Dividend investing can do well in both bull and bear markets. I love dividend investing because I don't have to time the market. I dollar cost average into my portfolio. I sleep well at night, and I see my dividend income increase month over month. So in this week's Review My Pie, we're going to answer a question that I got here on one of my YouTube videos a couple of days ago. Then we're going to see the first portfolio from a 36-year-old here in the US, the second a 20-year-old from the Netherlands, and then the third a 54-year-old here from the United States. The timestamps will be in the description below, as well as the portfolio links. If there's a link, it'll be in the description below. And as always, everybody, I'm not a financial advisor. Don't take what I'm saying as financial advice, just merely for your entertainment. And as always, everybody, I don't review the portfolios or pre-read the emails in detail before making these videos. I want to make it as genuine as I can, as if you and I are having a conversation live. This is generally what I would say, given the information that you've provided in the email, and just some things that are kind of on my mind, and just bear that in mind. But I will say this year has been, so you saw that VYM was positive for the year. VYM was trailing last year. So you look at VYM and maybe some of these other dividend ETFs. In 2021, a lot of people were like, oh, you dumb dividend investor, why are you investing in dividends? Why don't you go all in on growth and crypto? What's wrong with you? You're stupid. And I'm just like, literally I would read the comments and be like, Jake, that's so stupid. Why are you in growth? You're investing like my grandpa. I'm just like, well, your grandpa's pretty cool. Calm down. I mean, the market fluctuates. Every year is a little bit different. But I remember so vividly that, the comments that I would get on some of my videos where people would be like, you're so stupid. Why are you investing into dividend stocks? You should be all in on growth, or you should only invest into crypto. I mean, it was really hard in 2021 to stay focused and not get sidelined or distracted by all the noise around, especially around crypto. I mean, I can't believe the noise around crypto. But I mean, comparing 2021 with crypto versus 2022, it's looked a little like this. Oh my gosh. Tit for tat. All right, cool. So let's take a look at the first question here from Cyber. He wrote this comment on one of my videos that I made a few weeks ago regarding the FIRE movement and the total US stock market ETF and VTI. So Cyber writes here, I've watched a lot of your videos and you are by far one of my favorite investing channels. Well, Cyber, thank you very much. I didn't share the question because of the compliment, but I appreciate it. So you write here, I'm stuck between three options, 100% VTI, 50-50 between SCHD and DGRO, or a combination of the three in my taxable portfolio. I'm 23, investing heavily, 60% in income, and will bump it up to 70% when I graduate to hopefully live off the dividends in my 30s. Which option would you recommend, as I've seen you recommend all of these funds? Well, Cyber, this is such a great question. Let me share with you really quickly about some things that have been on my mind a lot right now. So when I graduated, I think from college, a little bit later than you. I did my graduate degree in Germany, so I was in school a little bit longer, though it didn't help me for my career that I'm in now. But when you're 23 years old and you're just looking to graduate, what I would recommend is, and I'm going to make an entire video on this, is really think about how your taxable and your tax sheltered accounts are going to work together. Don't just look at this with, from the lens of one account. Look at this from how can you take advantage of these tax sheltered accounts earlier in life so that you can coast towards FIRE in those accounts. So I'll give you an example. So in my tax sheltered accounts, I'm heavily investing into them now so that for the next 25 years, I don't have to invest another penny, so that it's just compounding in the background and it's all on autopilot. That's been a really big strategy of mine these last couple of years. And by doing that, I'm reducing my costs and my expenses that I would then otherwise have in early retirement, to have that stress. Oh, I still got to, fund these retirement accounts. I did that early in life so that they can coast, in the background for 25 plus years as I'm waiting to reach the age of 59 and a half. So that's one thing that I want to say is don't completely ignore your tax sheltered accounts. Look and see how you can take advantage of 401k, HSA, Roth IRA, etc. to optimize your taxes while you're early and making money. But really, I guess the question, here, you're 23, your time horizon can be anywhere from 7 to maybe, 15 or so years, 17 years. I personally, in my opinion, so this is what I do. I invest a large percentage in my Roth IRA and my tax sheltered account into VTI. I invested into VTI, VGT, VXUS, VNQ, Vanguard ETFs, and I put it on autopilot. Maybe what you could do is you could consider keeping it simple like that. If you want to take advantage of a tax sheltered account, you could look at VTI. And then if you really want to double down on dividend investing and really your plans of retiring off of your dividend portfolio in 7 to 17 years, look at ETFs like SHD and DGRO. And then if you wanted to complement those ETFs with a few individual companies, that's completely fine. You've heard me talk, if you follow the channel, you've heard me talk a lot about the core and satellite approach to investing. Your core can be these ETFs. And then if you wanted to add an additional, couple holdings, like 1 or 2 individual stocks or other ETFs, maybe sector specific ETFs, you could add those to either increase the growth rate, depending on your time horizon, or increase the dividend yield. Okay. And so those are kind of the levers that you'll have depending on your goals, your time horizon, your income, your expenses, all of those things. But for your core holdings, the whole point of, the simple path to wealth with dividend investing is to keep it sweet and simple. And when you're comparing the returns of VTI versus DGRO and SHD, they're very, very similar. So when you look at the price return, this is just the share price, you can see that they're fairly similar. When you look at the total return of them, that's where you're going to see a little bit of a separation between, the total returns. You can see that SCHD has performed the highest since the inception of DGRO, mid 2014. VTI has done well. So I think, just bearing that in mind, that all three of these are really solid ETFs. They're solid funds. VTI is not a dividend focused fund. This is generally most focused on a conservative, well-diversified total return. This is like the benchmark. I really like that. That's why it's one of my largest holdings in my Roth IRA, because I don't know what's going to happen in the next 20, 30 years. So I just set it and forget it. DGRO and SEHD are more focused, more tailored towards the dividend income, which I personally prioritize because I'm looking to live off the dividend income and not sell my shares per, the 4% rule, that the FIRE movement falls. So I hope that helps. And, you can track all of these things. You can do this all in Seeking Alpha. You can, do additional research on, what you're actually getting in these funds, what the holdings are, the expense ratio. You can do all of that stuff. You can do it in Seeking Alpha. You can do it all for free in Seeking Alpha, but if you do want to, double down and you want to get, really in the weeds when it comes to, the charting, looking at the different grades and ratings. If you're a nerd like I am, you can also consider a premium. You can use my link in the description below. You'll get the first year for $99 instead of $239. Seeking Alpha, they do sponsor the channel, so I want to be very transparent that I do benefit from this. I'm a huge fan of them. If you use my link, you'll get it for $99. If you were to go over to their website and try to do it, just through their website, it would cost $119, so $20 more. So you'll get that extra $20. But yeah, I do obviously benefit from it. I truly appreciate it if you use my link. But if not, that's cool. We can still be friends. Just bear in mind, you're 23 years old. I would guess that you're probably not married. You probably don't have kids just yet if you're going to college here. And if you don't have a house, most likely, those are all life-changing events that may alter your timeline and or your goals. So keep yourself flexible. Don't just think, I got to retire as soon as possible because it's a race and I got to beat all my friends. No, it does. I would recommend against that. Just understand that, your goals and your priorities in life are very, very likely going to change. As long as you have your core and you generally have a direction of where your North Star is, where your goals are, I think that's what's most important. Okay, so I hope that helps. All right, the first portfolio is from Christopher. He writes, "Hi Jake, 36 years old from Baltimore, Maryland, looking to retire around 55 to 60, currently maxing out my 401k yearly and $250 a week, dollar cost averaging into my dividend growth fund. I prefer to invest into ETFs to keep it more of a hands-off approach. Wife and I don't qualify for a Roth IRA, so REITs are in this account as well. Hope all is well. Thanks for reading." Well, Christopher, first off, thank you so much, man, for sending over your portfolio. I'll take a look at this from a time horizon of the traditional, retirement age. One thing that I will say, you mentioned that you don't qualify for the Roth IRA. That's obviously first world problems. However, what you can do is legally, there is a loophole in the tax system that you can take advantage of. What I would highly recommend you do, if you do not qualify for a Roth IRA, go ahead and Google backdoor Roth IRA. This is a legal loophole in the tax system when it comes to getting around that limit. Now, obviously not not financial advice. Go and Google. I love it when YouTubers say not financial advice and then proceed to give financial advice. Isn't that great? What I would recommend, go Google backdoor Roth IRA, do some research on that, and you might be pleasantly surprised. All right, let's take a look at your portfolio. I'm assuming that this is a taxable account because you mentioned you don't qualify for the Roth IRA. I mean, this could be a traditional IRA, but I'm just going to assume. So with your time horizon, because you said 55 or 60, I would and I think you mentioned you're already doing this with the 401ks. That is absolutely the right thing to do, right? So because you're such a high earner, you want to look to focus on lowering your taxes today, because you're probably going to be paying more taxes today than you are when you retire. I mean, it's just logical. If you and your wife are working, you're getting that W-2 income, you're going to be paying most likely more taxes today. Now that's counterintuitive of what people generally think. They think, oh, I'm going to pay more taxes in the future. Well, not really, because you're going to be making a lot less because you're not going to be working full time. Even if you have passive income, which is taxed more efficiently, dividend income, as long as it's qualified, is more tax efficient. So something to look into. So focusing on your HSA, your 401k, your tax, ways to lower your taxes. So your portfolio here, you got 25 holdings, a dividend yield of over 3%, a healthy expense ratio. I'm horrible at math. Let's take a look at this. You got 60 minus 36. So you got around 20 to 24 years before you're going to use this. If you're already a high earner and you're already paying so much in taxes, you may want to consider getting this dividend yield down. If you already know that you're going to probably retire at the regular retirement age, you are doing yourself a disservice in paying the tax man every year with this high dividend. Okay, so that's what I would highly encourage. And I look at your holdings. This is like a huge red flag. Real estate is your largest holding. If you're already a high earner, man, this is not tax efficient. This is not what you want to do. I'm glad you sent your portfolio, because this is what you need to hear is you're not optimizing your taxes, especially since you're a high earner. Now, if you're making like 60 grand a year, you're in a low tax bracket, hey man, who cares? You're probably depending on what state you live in, you're paying state and federal income tax. Man, you could be paying 35+% of your income in taxes. It's not ideal. You don't want to do that. So let's take a look at your real estate, V&Q. These are all really, really great companies. I own these as well, but for your time horizon in a taxable account, not ideal. The reason why I own these in my portfolio, and I'm a high earner as well, right? But I'm looking to live off of this portfolio in 2 years. You're going to be paying taxes on this for the next 20 to 24 years. Not ideal for you. So in my opinion, I would highly encourage you to rethink the strategy of, first off, having such a high yield, as well as understanding the difference between qualified and non-qualified dividends, because these are all non-qualified. SEHD is great. VYM is great. DGRO is great. I like this as your core. I do like this a lot. Healthcare specific, consumer staple, really great. Let's see what you got in your industrials. Love it. Great, great, great. This is really good. This right here, you see this 1.5% yield. This is what you want for your whole portfolio. You ideally, if you have 20 to 24 years, and especially if this is in a taxable account, this is the yield that you want. Maybe, anywhere from 1.5 to 2.5% current yield is what you should look for, ideally. Okay. Berkshire, okay, it's fine. SPYG, yes. This right here should be one of your largest holdings, right? This and this should be swapped. And now, your 20 to 24 year time horizon, in 15 years, in 20 years, you could then swap them. You could then say, okay, I got enough growth. Now I want to focus on current income because I'm 2 to 5 years away from reaching, retirement or living off the portfolio, whatever you want to call it. That's what you want to focus on. Right now, you're doing it backwards. You're looking at dividend yield equal good. No, dividend yield equal bad, right? Like, I tried to dumb it down and I sound stupid saying it that way. This is no. Large cap, okay, QQM. I've never actually seen this one before. I'm not sure what this one is. Passively managed? Okay. Yeah, I'm not actually familiar with that one. QYLD, nope, don't want it. You could take it entirely out. XYLD, take it completely out. RYLD, take it completely out. JEPI, take it completely out. Energy, do you think energy is going to be, what's energy going to be doing in 20 years, man? 24 years. Why do you even have it in there? Now, obviously for diversification, you could have it in there. There is energy in VYM for example. So if you did want exposure to energy, you're getting it with VYM, right? A small percentage, but by having this sector ETF, that is you saying, I want additional exposure to it, okay? Why? Ask the question, why? Why do you want additional exposure to it? Do you think that this is the next, boom? Like, there's got to be a reason why you have it in there. Right now, it's just increasing your dividend yield and just paying taxes. That's all I see is you're paying taxes. So I would highly encourage you to revisit this, understand what your goals of this portfolio are. If that time horizon is real and you want to, live off this portfolio closer to retirement, you want this to be a much lower dividend yield because you're paying the tax man. So, and yeah, these cover call ETFs, don't even consider them, in my opinion, until, a couple of years before you reach FIRE. What you can do is, 5 years or 2 years before you plan to retire, then add them. Even if you're reinvesting the dividend. One, it's a taxable account, you're paying dividends. Even if it was a Roth IRA, you don't consider these cover call ETFs until you're closer to reaching financial or until you're looking to live off the portfolio. So I hope that helps. It was brutally honest when it comes to your portfolio. There's a lot of things that I would, change about this. But that's just based off of the short email that you provided. I hope that's helpful. I hope that gives you a little bit of context for when you're looking at your portfolio going forward. Thanks for sending over your portfolio. The next portfolio is from Xander. He writes, Dear Jake, my name is Xander. I'm 20 years old from the Netherlands. I've been a fan of your channel for a while because of your way of explaining really suits me. Thanks for your videos in advance. Well, thanks, man. I appreciate it. I graduated last year, and in around a year, I will begin my career as a commercial airline pilot. My starting salary will be around $60K gross. My plan is to start working part-time on the day I become 50. Okay, great. In the meantime, I'm trying to invest around $500 every month at least. I'm living with my parents because my starting salary, I simply can't afford a house in the Netherlands. Furthermore, I'm around $120K in debt due to my studies. I have 30 years to pay it off. Oh my gosh, I thought the US was bad. Oh man, okay. I wanted to ask for your opinion about the best investing strategy for me. As you can see, my time horizon is at least 30 years. I just don't know if I should invest aggressively in high yielding stocks or in dividend growth stocks. I pay a 15% tax rate on every penny. This sucks, especially because there isn't a tax-free account in the Netherlands. Okay, by the way, can you give me some stock recommendation for a timeline? Unfortunately, M1 Finance is not accessible in the Netherlands to my knowledge. So below, I have sent screenshots of the current shares that I own. I wouldn't mind retiring early. My plan is to work at least a few years so I can be my father's co-pilot as he would be my captain. That is so cool. Your videos are really helpful, and I hope you will be making them you will keep making them. Much love from the Netherlands. P.S. You should try stroopwafel. Oh man, the thing about the Netherlands. So I used to live in Aachen. It's kind of close to Cologne, and I would always go over to the border, and I would get this what is it? It's like a yogurty thing. It's like called fla. And they would have like different flavors in it. It was so amazing. That was my favorite thing to do when I was living in Aachen. Okay, cool. So Xander, this is great. So first off, this is what scares me. $120,000 in debt. That is really, really scary. And you're 20 years old and you're making $60,000. So the first thing that I would ask you is, what is the interest rate? If this interest rate is more than 3 or 4%, I would aggressively attack this. When it comes to this kind of stuff, I'm more on the favor of, Dave Ramsey, get out of debt. Student loan debt is bad debt, in my opinion. In many cases, we could debate that all day, right? It depends on, what it can provide for you, et cetera. But in my opinion, that debt, it depends on the interest rate, but I would highly consider aggressively attacking that and trying to get that lower. You could set up, a monthly payment where you're paying off that, as well as you're paying off still investing. When it comes to individual stocks, in my opinion, I don't think the individual stocks are really going to help you. What I think is really going to help you is getting sound financial habits in place. Staying out of consumer debt, not paying more than what you earn, and looking for new ways to make more money. I don't think you picking the next Tesla is reasonable or something that you should really be focusing on. I think that's what a lot of people, they dug themselves a hole either with debt or other things in life, and they feel like they need to win the lottery. No, what you need to do in most cases, if you're a normal person, you need to have the basics down. You have to make sure that you're automating your investing, you're making wise decisions. Living with your parents is a great idea. I lived with my parents and, all through my bachelor's degree, right? You got to do what's right for you, but I would not look at this as your saving grace. I would look at what are the habits that you need to develop and how can you do them over a long period of time? Because you, my friend, you have a long time before you're going to be financially independent, unless something dramatic happens. But that's where people really get into trouble, is they bank on winning it big, where I think the slow and steady approach will win in most cases. So that's my initial thoughts there. When it comes to dividend stocks, I would focus, without even looking at your portfolio yet, I would focus on growth because you have a very, very long time horizon. All right, so let's look at your portfolio here. What do you got? You got 10 holdings. You got your portfolio value. You got your dividend yield. This dividend yield is way too high. Yield on cost, high yield on cost, annual dividend income. This is actually kind of cool how you got these metrics here. What portfolio, what holdings you got here? You got AbbVie. AbbVie is good. I'm not familiar with AFC. You got Duke, Enbridge, IBM, JP Morgan, Main Street, Altria, Realty Income, and Verizon. I don't know. This is really difficult. This is a very difficult one. Your taxes are 15%. I'm just trying to think of, when I tell you what my thoughts are, I'm just kind of trying to put myself in your position, your shoes. This is what I would tell you. Man, this is really, really hard. This is really hard. My gut tells me stay away from these utility stocks, these energy stocks, these slow growers in IBM, Realty Income, Verizon. Those are not the right stocks for you, for your time horizon. In my opinion, what you need to focus on with a 30-year time horizon at minimum, you need to focus on your total return. What you're focused on here primarily is the dividend. The dividend is only part of the total return, right? The total return is a combination of the share price plus the dividend. You're focused more on the dividend, and thereby the total return, in many cases, there's a few outliers. In many cases, it's going to shrink your total return, okay? So what I would recommend is researching high quality ETFs, not individual stocks, in my opinion, ETFs that are going to give you that total return. Some of my favorite are SCHD and DGRO. If you were to ask me, Jake, what would you prefer? Do you like these 10 stocks, or would you prefer keeping it simple and going with 50% DGRO and 50% SCHD? I would go with SCHD and DGRO. Now, I don't know if you can invest into those ETFs from the Netherlands. Maybe there's another ETF, the equivalent in the Netherlands that you can invest in. But that's what I would focus on. If you're 120K in debt, you're making $60,000 a year, the way that you're going to reach financial independence is not by picking the winning stocks. You're going to get there, as I already mentioned, through your sound foundation of getting out of debt, staying out of debt, cutting your expenses, and looking for new ways to make more money. That is how you build wealth. You don't build wealth by going and buying Tesla or NFTs or YOLOing on crypto. I'm sorry. I mean, some people get lucky, but for the majority of us, especially those with 120K in debt, you don't get wealthy by YOLOing. That's just the old man in me, just slow and steady, rethinking this. That's my opinion, how I would look at this. If you did want to invest in individual companies, go for it. That's fine. Make it a small percentage of your portfolio. But in your case, Xander, I would consider adding growth ETFs for your time horizon. So I hope that helps. It's probably not what you wanted to hear, but it's probably what you needed to hear. So take it for what it is. Thank you so much for sending over your portfolio. And I'd love to stay in touch. Shoot me an email. I'd be very curious here down the road, how you approach this. All right, the last portfolio is from George. He writes, "Hello, Jake. Any particular reason why you don't recommend bond ETFs? I'm 54 and I've been watching your videos for a while now, and I've been doing my M1 Finance pies based on your reviews. Quite honestly." Okay, well, that's cool, man. Would like to see your take on bond ETFs. Just rolled over the Schwab's pension and 401k into a traditional IRA as I left the company I was working for 20 plus years. George, congratulations, man. 20 years. That's incredible. Thinking about adding some bond ETFs to combat inflation. I may start living off dividends in about 5 to 7 years. Let me know what you think. Here is my IRA pie and your bond ETFs. You got BND and you got TIP. If in 5 to 7 years I start pulling from my IRA, I would love them. I will move them to this dividend pie as my daily living income. Let me know your thoughts. Well, hey, this is so cool. So George, I think over the years I've really just kind of shunned bonds as just like not even applicable. Now, it really depends on your time horizon. If you're 23 and if you were to ask me, Jake, do I need bonds? I'd say absolutely not. No, you don't need bonds. Bonds are all about wealth preservation. They're not about accumulation. And most of the people following my channel are in the accumulation stage of their life. Now, for you, as a 54-year individual, bonds can absolutely play a role in your portfolio, especially now that you can get over a 4% yield on a treasury, essentially risk-free. So yes, bonds today are absolutely viable. Now, a couple of years ago when they were yielding like 1%, do you really need bonds? I guess you can. For a 54-year-old in today's environment, 100% bonds are absolutely a viable option. Now, in 1 to 2 years, if the yields go down, right, could that change? Yeah, sure, of course. You can always adjust your percentages, your percentage to bonds. Really, there's a couple of reasons why you would hold bonds. And I've shared this a handful of times on the channel. Let me just briefly mention it really quick. So the reason why you want to hold bonds, depending on your time horizon, a couple of things. So bonds add a lot more cushion to your portfolio. So you're not going to see as much volatility in the value of your portfolio. So that's the first thing. Generally, when equities, stocks go down, bonds usually go up, right? Usually. Now, we didn't really see that here with the pandemic in the last couple of years, right? The market has just fell over, right? This has been the worst time to be a bond and stock investor. The 60-40 portfolio has been annihilated. We've not ever really seen that. So generally, when stocks go down, bonds go up. Okay, but that has not been the case these last couple of years. So that's the first reason is, when stocks go down, bonds usually go up. And then a lot of times what people will do is they will rebalance, they'll sell their bonds and they'll buy stocks at a discount, right? So they'll do that. So yeah, it's the peace of mind, the low volatility, the low fluctuation in your portfolio value, as well as the potential to rebalance. So those are usually the reasons why you would hold bonds. Now, if you're in the wealth preservation stage of your life where you're approaching 50 or 60, 100% bonds should be on your mind of fixed income, right? Fixed income to, maybe some high yielding bonds. They can definitely be part of your portfolio. So that's how I view bonds as a whole, but it really depends on your time horizon. So just something to bear in mind. Okay. So let's take a look at your portfolio here. So the first one in your Roth IRA, you got SCHD, VYM, JEPI, and RYLD. I really like this. I did not look at this portfolio until just now. This is great. I really, really like this. You're 54 years old. You got SCHD, you got VYM, JEPI, and RYLD. This is incredible. I mean, you could throw in the DGRO. I'm going to double down on that every time. I love DGRO because of the growth, but SCA and the diversification. But VYM is a good substitute for DGRO because of your time horizon. Okay, I really like this. This is something that I would love to get my dad to look at. This would be perfect. Like, something comparable like this would be perfect for my dad. Like, my dad is in his 60s and he's like all in on oil. And I'm just like, ugh. I mean, obviously he's doing well right now, but I really like it. Sweet, simple, cover call ETFs, really good. I like it. This is MIO. I'm not sure what MIO is. This is in your taxable account, I guess. So this is where your fund's at. Okay, so let's see here. You got your top dividends at 30%. Oh, you got the QYLD, RYLD, JEPI. Not familiar. Okay, RS Capital. Okay. I don't mind it at all. You know why I don't mind it? I think it's fine because of your time horizon. Now, if that 20-year-old from the Netherlands had a portfolio like this, I would have torn my hair out and screamed at the mic here. For you, I think this is fine. The cool thing about this is you're getting the high income. I'm hoping that you have a little bit of growth in here as well, because inflation is not going away anytime soon. You still want to make sure that each year you're getting a pay increase with a growing dividend. All right, so let's see what you got here in the 2035 moderate. Is it going to let me look at this? It does not let me. I don't know why I'm on finance. When you share the link, for whatever reason, it doesn't pull that up. So what it's most likely, it's probably got a combination of some bonds, and it's possible that it's a target date fund. So, a combination of growth and income is likely what that is. That's fine. Let's look at your energy EPD. So this is what it looks like for my dad's portfolio. The EPDs, the ETs, and that kind of stuff. That's cool. I think it's fine. Consumer, Altria, Pepsi, Coca-Cola. So you got a good combination of growth and value in here. The only thing that I would say, having 1% in Target and Lowe's, depending on the value of your portfolio, let's say it's like $1 million. Let's do this. Let's do the math here really quick. I'm curious. So you got consumers. Let's do this. 0.07 times 0.01. That is how much you have invested into Target and Lowe's. And now let's say you have $1 million in here. You only have $700 invested into Target. Now, if you had 2 million times 2, you got $1,400. Are you really an investor of Lowe's if you have $700 from $1 million portfolio? And let's do this. Lowe's, you're getting like a 2.5% dividend yield. 2.5%. That means yearly you're getting less than $18. Every quarter, you're getting like $4. Are you really an investor of Lowe's and Target? So I think that's something that I would consider, are you really an investor of Starbucks getting $4 in dividends per quarter? In my opinion, no. Does it make sense to have them? Probably not. It all depends on you, but that's just how I view it. It's like, if I'm making less than $100 a year in a dividend stock, is it really even worth it? I don't know. That's just my opinion. PPL, didn't they just cut their dividend? That's pretty, I think they cut their dividend here recently. Not the biggest fan of PPL. I like Southern. I like Duke. I like Energy. I like these three. Utilities, real estate. Omega, great. You know what's funny is Omega was my lowest performing REIT in 2021. It's my highest performing REIT in 2022. It's just like with crypto, everybody. You know, in 2021, everybody was bashing, you know, this or that. And now it's been flipped upside down. That's why it's so difficult to time the market, right? You know, people that sold Omega at the lows last year, and now it's one of the highest performing REITs in my portfolio. That's why it's so difficult to time the market, right? Realty income is good. Store, are they getting taken private? I think they're getting taken private, if I'm not mistaken. Good, great. Simon, good. Welltower. Okay, cool. Yeah, I mean, you know, if you have your Roth IRA, what you could even consider doing is adding this to your Roth IRA if you wanted to make it even more tax efficient. But yeah, that's up to you. Healthcare, you got some good companies in here. The weighting is fine. That's fine. Tech, IBM, NVIDIA, Apple, Microsoft, Tesla. Yeah, that's fine. I mean, to each their own, right? I mean, if you want to have that, yeah, I mean, it's fine. Financials, Wells Fargo, Bank of America, JP Morgan. T. Rowe is good. Monroe Capital. I'm not familiar with Monroe. This is the first time I've actually seen it in any portfolio. I'd be curious. Maybe this is where you bank at. Maybe you're a consumer of this bank. You know, maybe you have a checking account with them or something. Industrials, 3M, Waste Management. Yep, I like it. 3M. Okay. Waste Management. So you got the current income and you got the growth with Waste Management. Telecom, Verizon. Yeah, I think that's fine. I mean, with your time horizon, this is a good use case, right? Like when you're comparing Verizon versus Comcast, a 20-year-old would want Comcast, where you would want Verizon if you're focused on the dividend, and, you know, because of the compounding nature and the time that it has to compound and grow, makes complete sense. So I like this. I think reasonably and arguably, George, you could cut this in half and make your life so much easier. Like, in my opinion, like a lot of these, you could probably trim this like 3%. Is it really worth having it in there for 3%? Let's see, you got the healthcare, 8%. Okay, it's fine. This right here, this is what I would, you know, probably reconsider. Does it really make sense to have all of these in here just at 1%? Now, it's possible that you have the M1 rewards card and then you have it in there, and when you shop at Starbucks, you get a higher return. So that's actually very possible. That's maybe something what you're doing is you have the M1 rewards card and you have to have them in the portfolio to get those extra points back. So that's possible. But if that's not the case, I would definitely consider, well, does it really make sense having all those in the portfolio? Thank you so much for watching, everybody. I hope that the video was helpful. I think, you know, each one of these portfolios was a little bit different time horizon, different goal, different strategy, different approach. And, you know, I'd be curious, you know, what are your thoughts? Is this, do you agree with what I was saying? Was I too hard? Was I too light in terms of my feedback? Was I too nice? You know, just be curious to hear your thoughts. Thanks for watching. I'll see everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.